Hi, I'm Paige Deers. We are bringing you the insights from the NBA conference in San Diego, where many of these experts are talking directly to the lenders here in the community. One of them is Keith Lorgay. And Keith, you've been talking to lenders. What is something surprising you're hearing in the discussions here at the show?
Yeah, one of the most surprising things we're seeing in the market today is that we've had a tale of two cities whereby lenders over the past 12 to 18 months have really only wanted to focus on primary markets, gateway markets, and the best Class A assets. As we've seen a rush of capital coming back into the mortgage market, lenders are starting to get more aggressive, take a little more risk, and deviate from that. They're willing to start to go to not just the five or six big coastal markets. They're willing to start going to some smaller towns, maybe not the Class A assets, start lending and focusing on some Class B assets that may need a little lease up or have a little more risk. And so we're starting to see the capital start to flow there.
Well, that's good news. Capital is important.
Yes, it is.
We're also hearing a little bit, too, about mezzanine debt. First time I've heard that in a while.
Right, I know. All of a sudden, mezzanine capital is now necessary in the market as we're starting to deleverage, which is a process that's going to take probably 3 to 5 more years, from the peak of 2007. In order to deleverage some of these assets, we're going to need new slugs of capital. And so we're seeing very aggressively priced mezzanine money that's priced anywhere from, say, 8% on the low end to 12 or 13%, which will enable companies and properties to reduce their leverage, bring in new capital so that there's funds for tenant improvements, leasing commissions, and deferred capex. So this is a positive development in the market today.
That's good. So you've got mezz back, and the
Yes.
Conduits are back. So does
They
that
are.
mean liquidity is now really flowing into the market?
It is. It's coming back. We're still undercapitalized overall within the market, but given where we were 12 months ago, it's still a vast improvement. We're going to continue to see more and more capital flow. It'll start to take more risk, and a lot of the assets that you really couldn't touch or refinance even 6 months ago, you're starting to have options available at reasonable terms that make sense for current ownership.
Okay, good. So if you've got options available, does this really mean that we are fully in recovery, or is that?
Well, we're fully in recovery from a capital markets perspective. The question is, what's happening with the underlying economy? We're starting to see job growth in the private sector, which is good. We're not seeing enough. You're not going to really see true recovery at the real estate level until we have more job growth. We need 200,000 or 300,000 jobs to be created every month. Right now we're somewhere around 100,000, but at least we are moving in the right direction, and we are having job growth. It's not job losses anymore. So, whether or not it's a year from now or 3 years from now, we're moving in the right direction. But let's hope the trends continue to improve.
Yeah, let's do. It sounds like they will. So that's a call out to the companies. Start hiring. We need to see
Exactly.
some job growth.
Exactly.
Well, thanks for joining us, Keith. I'd like you to stay tuned because we'll be bringing you more insights from here at the show at NBA.